Good morning, everybody, and thank you so much for joining us this morning for this webinar around rethinking cash flow. It's actually one of those interesting topics that when you put these events out, when you get as many people as have signed up for this today, it kind of really shows you that this is a topic that businesses are really looking at. And as the title slide there tells you, this is very much as we come towards the end of all the many government support measures to get businesses through COVID. As you can imagine, what we want to do our utmost to support businesses to keep going and to come out strong. And so that's very much kind of the focus here. In terms of the webinar, if you just pop on to the next slide, I'll just give a quick introduction to the people speaking and a very brief overview. So the main focus on this webinar is actually our working capital study, which Jenny Schutt has led on. And there'll be a lot of insight coming from the research on what businesses have done over the last year and how they've adapted, coped, and some of the challenges that lie ahead. So Jenny will be speaking around that. And also really pleased to have Ben Walters from Compass Group talking to us about how a real business actually has dealt with the cash management through this cycle and the challenges they now see ahead and how they're dealing with those. And also Maurice Benisty from Demica talking to us about supply chain finance, one of the really brilliant ways of helping with kind of cash flow challenges that might be arising. So a wide range of different topics here. And in a second, I'll just be handing over to Mark Shaw, who will be, he's our head of business restructuring, and he's going to give us a little bit of an overview on the landscape that lies ahead. But just before I do that, there is a chance for people to ask their questions through this. Down the bottom of your screen, or should be bottom of most people's screens, you will see a Q&A function there. And in that, if you just put your questions as you go through, we will pick those up and we will answer those questions towards the end. So please do use that, and we'll do our utmost to answer those questions. Can't get around to the questions on the session, then we'll answer that afterwards. But please do use that Q&A function. But without further ado, the next 45 minutes, there's a lot of content in there. We really hope that you get a lot from this, but I'll hand over now to Mark Shaw and the landscape that lies ahead. Thanks, Mark.
Good morning, everyone. I am the head of restructuring in our firm, and you might think, why are we starting here? And the answer is probably simply that for every debtor, for every creditor that's not paid, that's somebody else's debtor. It's a zero-sum game. And the way we look at things in terms of restructuring is if people don't pay their creditors, then obviously somebody else's cash flow suffers. So I'm just going to start now talking about the current market environment. So I've used Atradius's numbers, the trade credit insurer that some of you will know. There's quite a well-known survey out there, a research paper they've done. And despite the fact that the pandemic, I think if we wound ourselves back a year, everybody thought that insolvency volumes would rise dramatically. They haven't. They have plunged everywhere in the world pretty much. So 2020 to 2019, they're down about 14% globally on average. Now that's very, very different in different countries. The countries with the most fiscal support and legislative support measures, they've dropped more. But Atradius do think that 2021 to 2020, they are going to rise by 26%. So they're going to more than make up the drop and about another 12 percentage points on top. So that's a global picture. If you look at the UK picture, which are actually based off England and Wales numbers, but they're broadly the same, they've dropped about 27% year on year. Now, of course, that 27% includes Q1 of 2020, which was a pretty much a normal trading quarter. So that 27% drop happened in 3 quarters, not in 4. And that's nearly 5,000 fewer insolvencies in 2020 than 2019, which of course begs the question, as what was so much better in 2020 than 2019 economically, but for COVID and but for the support measures that would cause a 5,000 drop in insolvencies. So it's a very, very big change. Atradius think that the UK will rise 2021 to 2020 by 56%. And that if that's going to happen, it will happen towards the back end of the year, which means could be quite dramatic because obviously we're 4 months through it now. And if we look for most of the last 12 months, we've been running at 40 to 50% down. As I say, the 27% covers the whole of 2020. But if you just take it from April onwards, probably now running at about that kind of level. And those are, I've never seen that in my career. I mean, I started work in the 1992-3 recession. And when been through the dot-com downturn, the GFC, I've never seen that kind of fall in insolvencies, even in the biggest economic booms we've ever seen. So it gives you an idea of how big an interference it is. So what caused it? In the UK, it is unprecedented. And that word is overused, but here it's rightly used. Economic and legal measures, and most of you will be familiar with them. So state-backed loans, whether it's C-bills, CL-bills, CCFF, recovery loans, bounce-back loans, all of that panoply of things. Rates waivers, deferrals of taxes, both the VAT from Q2 last year, and on top of that, time to pay arrangements. There's been the furlough scheme. There's been winding up petitions, and statutory demands are pretty much outlawed. It's very, very difficult to wind a company up for non-payment of debt. Wrongful trading as to all real purpose been suspended. Landlords can't forfeit a lease or distrain on assets. So this sort of big freeze gun has been applied to the economy at the same time as just rafts of liquidity have been pumped into it. And a similar story has been globally, but we have one of the more interventionist regimes here in the world, which is quite astonishing when you compare it with, we have a conservative government, but has probably been more interventionist than any Labour government has been during my lifetime, perhaps other than the 70s. So is this like a normal downturn, whatever that might be? So a normal downturn is a demand-side shock. So in the GFC, which started August 2007, really, and sort of played out through to 2009, there was a liquidity crunch, and that caused a fall in demand. The pandemic is different because it's a supply-side shock with excess liquidity. So the lessons we can learn from the last downturn are very limited in the sense that everything's on its head. And it's a supply-side shock, like a war is. So it's the same principle where people still want to consume things, but they're told they can't because they have to stay at home and certain businesses have to shut. So sectors vary with the state intervention we've seen. So any business where people mix and mingle to buy things or consume things in real estate are going to have been affected more. So leisure, hospitality, retail, so on and so forth. Those sort of consumer markets businesses. But other businesses like professional services have actually done very well, unsurprisingly, perhaps, where we are now. So what's the path out going to look like? It's really uncertain. So the Atradius research is one thing, but each time those measures are extended, it changes the path out, I think. So will we have a roaring 20s? Like was seen after the First World War with the flu pandemic going then, and also the war subsiding. If we do have that, there's probably 200 billion plus of savings here, roughly the same as the 10% drop in our economy. How much of those savings will be spent? The UK has a very high consumption propensity, one of the highest in the world. But what we don't know is how much of those savings, on a non-average basis, have accumulated in wealthier people as opposed to poorer people, who may see some of it as accumulated wealth and not money to be consumed, i.e., put simply, there's 200 billion saved up, most of it's at the top end of the economic pile, and we'll spend 50 of it, but the other 150 is now sort of wealth money, it's not spending money. And that's human nature. So if we do see a big splurge, the insolvencies will stay low. Inflation will rise, though, for a whole host of reasons, to do with Brexit, to do with demand, inefficiency, still some social distancing. And that will create its own downturn in 2023 because interest rates will rise. And when we say they will rise, they can't drop really because they're almost nil/negative as it is. So they can only go up, and that creates its own pressures. So if the savings aren't spent, though, then we'll see much higher insolvencies earlier, lower inflation. And the key thing in all of this is, what are the inflection points? What is the human nature crossroads which changes this stasis that we're in now economically through excess liquidity and legislative measures? So that leads on to the question of ending the measures. Now, I'm part of a group which liaises with various people, government, stakeholder groups, and all the rest of it throughout my profession. So we have a lot of conversations with people to work out what's going on. And what is clear in it is that the drum that we've been banging is that how we end the measures is as important as when we end them. And there's this idea of a cliff edge. So in the end of June, we could drop all of these measures, and then it could just be a free-for-all to try and work out what to do. And so you've had enough time to get your affairs in order. They could be a tapering of the measures at the end of June. They could all be extended, like furlough has been, to the end of September, and they could cliff edge then, or they could extend, or there could be another wave and it could extend again. And at the moment, we don't know. And even though we're at the end of April, we still won't know until the end, probably nearly the end of June. There are consultations going on from government to try to work out what to do, particularly around ending the landlord measures. So in my head, though, I think we've got what we call a bubble wrap effect, which is that as from the 1st of July, in effect, we get the economy really back on its feet. To my mind, it wouldn't make much sense, having come this far, to then take the bubble wrap off and let there be a free-for-all. It seems to me to be far more logical to leave the bubble wrap in place until the end of September, allow people to build up a bit of cash, get things back up and running again, and then take that off. But who knows? And then there's the overlay of it, of the reversion to norm versus pandemic insolvency volumes. So we've got the 5,000 that haven't happened, which would have happened but for the pandemic. But then on top of that, there could be a load more insolvencies from it. So whichever way you cut it, all logic tells you there's this pressure sitting behind us for companies to need restructuring and or fail. So the current market environment, how does that all play out at a company level, all that stuff? And the answer is, I think you have some companies that were viable before the pandemic and are viable after, and they're probably cash generative too, and others where their business is obsolete. And obsolescence has been accelerated by this downturn. So lots of change is going to be wrought by it that would have been wrought anyway, but has now been brought to today. And then you did different tools for viable businesses versus obsolete ones. And what you've got here, unusually, is a balance sheet balloon. A lot of trade creditors have been paid in full. You know, I'm sure many of you on this call have seen very low bad debts, debtor days falling, but that's not the real world we're in. That's artificial at the moment. And it's been caused by this balance sheet balloon of HMRC debt, HMG-backed loans, and rents that haven't been paid. And at some point, that balloon needs to be dealt with. Now, unusually, it's a surgical strike on a large group, a small group of large amount creditors. And the key thing with a business, even if it's viable, is how much free cash flow does it have to settle that balloon, and can it do it quickly enough to meet those creditors' demands? And I think there could be a difference here as well at a human nature level, not because I'm advocating the duties should change, but between an owner-managed business and one where the shares are owned differently from the management. And the reason I say that is it's all very well those big balloon of creditors on the balance sheet saying, well, you can work for the next 10 years to pay it off. But people's memories are short. And they may say, I don't want to work for 10 years doing that. We may have all been in it together, and I was really grateful for that support. But actually, I want my company back, and I want to work for me, not for you, for the next 10 years. So there's some real human nature things I think we could see come out of it, particularly for owner-managed businesses. So what type of insolvencies and how many will we see? So I call it a surgical balance sheet strike. You have to get that balloon and strike at it. And in order, so in a sequence here, you have consensual restructurings where you just reschedule, compromise, whatever, but you need advice because you need to work out what would happen if you didn't do a consensual restructuring. If that fails, or as a threat for consensual restructuring, you can use statutory cram downs, things like restructuring plans, CDAs, or for large company schemes of arrangement. If they don't work, those are more for the viable end. For the obsolete end, you can sell bits of businesses using an accelerated M&A process with a pre-pack insolvency, or if it's completely obsolete and or it's riddled with fraud or something, you can just shut it down and liquidate it. So you have a bit of a cascade, and it goes to that viable, obsolete, fraud type bucketing up. But what is clear, I think, to me as a restructuring professional, is that the nature of this crisis has been unique. It's created unique consequences, and therefore it must follow that the solutions aren't just the same ones that we've always had. So we need to look at the particular solution for the particular consequence we see. Then overlaying all that again, we have societal and legislative change. There is a big push from our government and society to move to a debtor-centric approach. We have been very creditor-centric in the past in the UK. We are now much more debtor-centric. The laws existed, but now there's pressure to do it from government. And that creates more of a desire to rescue a company as opposed to the business within it. Hence why cram downs and consensual deals versus AMAs and pre-packs. And we had new law introduced last summer, born of an EU law, ironically, despite Brexit, which introduced the restructuring plan and moratorium and what are called ipso facto, i.e. continued supply clauses. And I won't go into those today because it's a bit of a subject in itself, but just suffice to say that those measures are very much more geared, giving new tools or arrows in the quiver to be able to restructure a company as opposed to a business. So just to wrap up and in conclusion, all of these issues affect working capital because, as I say, everyone's creditor is a debtor in one way or another. And so much is up in the air in it. So we're trying to horizon scan, if that's a verb now, to work out which way everything's going to go. But we need to look at how vaccines are working, how the economy is going to open up, when it's going to be opened up, how government support is going to be ended, how much saving is consumed, where inflation comes in, and where that inflection point comes in, i.e. are creditors, that balloon, willing to do deals, and is there going to be a rush to the pot, which creates a bit of mayhem for a period when all these measures end. So I think we have to all keep our eyes and ears open to work out when this very peaceful calm looks like it might end and what we might need to do in response. I'm going to hand over to Jenny now to pick up on the more technical core of the presentation around working capital.
Thank you, Mark. Good morning, everybody. Thank you for joining us this morning. My name's Jenny Schutz, and I'm the BDO's Working Capital Advisory Lead. Just as a little bit of background to myself, so I started my career with supply chain logistics roles at BMW in Germany and the United States before progressing to a procurement role with the Estée Lauder companies in the UK. So I have a lot of industry experience, particularly within supply chain and manufacturing environments. Subsequently then, for the last 14 years, I've been supporting businesses with optimizing their working capital management across a host of different sectors. And one thing that I can say from the learnings from that is that there are some good practices that can be applied across all businesses of all types, sizes, sectors, which we'd like to take you through some of those today. I would say that the main focus on working capital throughout my career has probably been around 2009. So post-collapse of Lehman, businesses were really firefighting and looking at improving working capital to fund critical operations. Since then, we've obviously had incredibly low interest rates, and there hasn't been as much of a focus on working capital management. And we'll see that from some of the data that I present. So companies are focused more on revenue growth and EBIT as value creation. This, however, over the last 12 months has obviously changed. So cash is more in the forefront of management teams' minds. If we think about what Mark's just said relating to potential fallout, so those businesses that potentially being propped up that were struggling pre-pandemic, we've got businesses, healthy businesses that will have also had access to funding, but we do expect at some point to see some fallout. So it's still really uncertain the times ahead, and it's a really good time to think about your working capital management practices going into the next few months. So if we could go to the next slide, please. Thank you. So today I'm just going to take you through a few highlights of the study, and I'm also going to take you through a few practical tips of things that you can be considering before those government support packages start to phase out. So this is a review of historical balance sheet information. We have the measure of what we call the cash conversion cycle. So the cash conversion cycle is a barometer. It's basically looking at the number of days it takes for a business to convert its inventories or its investment in inventory and other resources into cash from its customers. And what we can see is leading into the pandemic that was steadily increasing and a slight improvement running into FY 19-20. However, there's still over £288 billion sat on balance sheets across the UK alone. There's two main drivers of performance of working capital. So firstly, it's around the size of the business and the leverage you have. And secondly, it's the sector in which you operate. So if we think firstly, the size of the business, there are approximately 6 million businesses in the UK, 5.94 million of which are classified as small. And when we look at the study, the only category that actually improved their working capital performance across this period were those companies that were generating over £1 billion of revenue. So really, as we go forward, it's going to be really important that we're working in that spirit of collaboration and those large businesses as supporting the smaller and medium-sized businesses to continue their supply chain. If we think then about sector, so if we take an example of professional services, hopefully the cash conversion cycles are quite short. The types of things that they'll be looking at is WIP management, how assignments are being led, looking at credit control and how cash is being collected against debtors. Whereas if we look at manufacturing that has typically long cycles, potentially sourcing goods, raw materials from the Far East, you've got flexes in demand, changes in forecasts, and making sure that they're reflected in the demand planning and the materials that you're ordering, so you don't end up with lots of slow moving and obsolete stock is going to be really key. So the drivers that you have per sector are going to be different, and it's really important to understand what's available to you. If we move on to the next slide, please. Thank you. So cash was cheap, there wasn't a lot of focus on it, and therefore the working capital management practices were deteriorating. If we look here, we've got a view of cash reserve data. According to our study, Rethinking the Economy, 18% of businesses highlighted that access to cash is going to be their #1 challenge in 2021. Some of the support measures have been lengthened in the meantime, but we can all see the importance of cash for businesses that we interviewed in that study. This particular chart looks at the Office for National Statistics data. So this is an economic confidence barometer that they're publishing every 2 weeks. And it looks at 10,000 businesses across the UK. And what we can see is the number of businesses that have 1 to 3 months, of cash on hand is increasing steadily, and that's around 28%, so almost 30% of businesses. But then conversely, we've got businesses that are saying that they've got over 6 months of cash, and that's also increasing. So we can see, again, very varied vulnerabilities within supply chains. And coming back to Mark's point, and one of the points that I did want to make this morning, is that as we start coming out of the pandemic and the support measures start to phase out, I'd really recommend continually monitoring the financial health of your key customers to make sure you eradicate any risk of raising bad debt, but also looking at supply chain and suppliers and making sure that you continue to flow the cash where possible and there's a continuity of supply at the other side of the cycle. If we then move on to the next slide, please. Okay, great, thank you. So this is showing the highlights from the qualitative research we did in the study. So these are thoughts that came from our clients and thoughts from the experts that we have in-house. Many people or many businesses will have been looking at some of these already. I would recommend and encourage you to continue to do that. Hopefully there is some insights for businesses that haven't started this, but again, before those measures phase out, I would be encouraging you to take a look. I'm not going to walk through all of them, but I'll just pick a couple of the key ones for myself. Strategic priority. So as we've said, cash hasn't been a strategic priority. It needs to be, and that message needs to be at a board level, an exec level, and it needs to be cascaded down throughout your organisation. Transparency and metrics. So we talked really high level about the cash conversion cycle, which is great, but that needs to be broken down into its component parts. So looking at your receivables, inventories and payables, and there are lots of other operational performance metrics that can be identified and tracked to understand where any deterioration in performance is coming from. So transparency for me will also be key. Also, roles and responsibility definitions. So I looked at the invite and attendee list for this morning's call. A lot of finance directors, CFOs on the call, which is great. Ultimate accountability generally sits at that level, but there's lots of people across the organisation that impact your working capital. It's very cross-functional, very cross-operational. So it's really important people understand what impact their process and their role has on the overall balance sheet position. And coupled with the strategic prioritisation and the communication, it helps to embed that awareness and the cash culture through your organisation. Looking more medium to longer term target operating models. So a lot of our clients have started looking at the effectiveness of the target operating model, particularly finance function and how this supports optimising working capital processes, through to looking at skills, providing any training where there are skills gaps, and automation. So not only improving your cash, but looking at opportunities to improve the effectiveness of your process, to reduce cost, and also potentially look at FTE reduction, which has an ultimate impact on your P&L. The final two then, I'm going to ask Ben from Compass shortly to talk through cash flow forecasting. One point I just did want to mention finally was around working capital funding solutions. So from my experience, this has been very much for large corporates looking to extend payment terms and push their payables balances out. There's really been a shift in focus. So it's not purely large corporates that are looking at this. There are a lot more mid-market businesses that are looking at it, and the purpose has changed. So rather than it being purely a terms extension piece, it's really that corporate social responsibility aspect that's coming in as well. And I'm going to invite Maurice from Demica to talk through that shortly. So in summary, we've been in a fortunate position for many years. There's still a lot of uncertainty that lies ahead. We've had a shock, we've experienced a lot of turbulence. We know that we need to expect the unexpected, and it's a really good time to rethink our approach to working capital management. As Mark also suggested, we have the risk with lots of money being pumped into the economy and savings at all times highs, that there could be inflation. This would impact your working capital balance. It would also impact your cost of funding. So it's really important, I would say, to start to embed that cash culture if you haven't already, and make sure everyone across your organisation is aware of the importance of it. And B, within your sector and your given parameters, think about what levers you have to pull and start optimising the processes. So at this point, I'm going to ask Ben Walters. So Ben is the Deputy Treasurer from the Compass Group, to share his thoughts on, give us an overview of the group and share his thoughts on the importance of cash and working capital to Compass. So morning, Ben.
Good morning, Jenny. Thank you for that introduction. I think if we just flick on to the next slide, which gives you a very high overview of the Compass Group. Now, some of you may not actually have heard of Compass, but I'm pretty certain you will have been fed by us at some point in your life. Compass is the world's largest catering company. We operate multinationally across 45 countries and in sectors such as business and industry, education, healthcare, sports and leisure, defence. So, as you can imagine, the onset of the pandemic last year had a significant effect on the business. You can see that our revenue in the first half of last year, and by the way, we have a September year end, so that's up to March, was significantly more than in the second half of last year. And of course, with a lot of the business closed because of lockdown restrictions, a huge impact on operating profit. However, cash was a success story last year, as much as it could be in this environment. And what we were able to do very quickly was implement, some of the key levers you'd expect a business to be able to pull in this situation, which were around reducing CapEx, M&A, but also, I think, much more relevant to this discussion, focus on working capital. Now, obviously, governments, a lot of governments around the world put in support measures which were hugely helpful for working capital. But, one of the messages would be there was a really good old-fashioned concentration on the nuts and bolts of working capital. For instance, in the accounts receivable teams throughout the world, we were able to divert resources, i.e. people, towards supporting accounts receivable collections. For instance, our internal audit team, who were no longer able to travel, stepped in and supported accounts receivable. We also had a real focus on our client list and our contract base, looking down sector by sector, client by client, to identify those that might be most affected by what was going on, and just staying very close to their situation. I think in practical terms, linking back to Mark's message, was that in actual fact, we saw liquidity still remaining pretty strong out there in the market, which I guess is one of those fallouts from the huge amount of support governments did put in place. If we could move on to the next slide, please. Thank you. So some key observations would be, at the height of a crisis, when things were unfolding very rapidly, I think the message is that swings in working capital, cash swings in working capital, can far outweigh the impact on profitability. And obviously, over time, profitability drives cash performance. But in the short term, in the first 2, 3, 4 months, working capital is the dominant factor. Let's hope we never have to go back to that again, but it's very worthwhile bearing in mind and underlines the importance of understanding working capital. We felt our forecasting process needed a rapid improvement. So, in real practical terms, we rewrote our forecasting process. So literally, we had a joined up P&L and cash flow which fitted on a single screen on someone's laptop. We cut out a lot of extra data we were collecting. We really streamlined it down, but we made sure that P&L and cash tied up. And we also looked at comparing forecast on forecast. So we were running rolling forecasts every 1 or 2 weeks, but comparing the newest forecast to the previous forecast to find out what was actually changing in the business. Working capital, what can I say? I mean, it's much more than just a process. I think we always, there's always a deep understanding of that. But I think to actually truly manage working capital properly, you need to understand your business model, your strategy, and your culture. All lessons underlined by the pandemic. And I think good forecasting at the end of the day, really, you have to appreciate it is a bottom-up process which involves a lot of teams. It's not simply an exercise on a desktop by a management accountant. It involves your AR, your AP, your payroll, your tax teams, your commercial people who are actually they're selling to your customer or client base. So our message when we looked at our forecasting process during the crisis was very much that forecasting, although we slim this down, it fits on 1 page. Actually, there's a lot of work behind this and a lot of input that needs to come from different teams. So get those processes in place where those teams are constantly talking and updating their part of the forecast and really owning it. So those would be the key messages from myself on this.
Thanks, Ben. That was great. Just picking up on a couple of points, if I can. Firstly, around the messaging and the importance of working capital. So you mentioned the impact that it's had and that the crisis has highlighted the importance. Is it one of your top strategic priorities? And how do you think you'll continue with banging the drum and the message that it is really, really important?
Yeah, no, I mean, like I say, it always has been very important to the group, but I think it certainly was underlined during the crisis. You step in as a treasury team in those circumstances, and cash really does become king. I know it's a cliche, but I think the other point to make about good working capital management is that it's a barometer of how efficiently your operation is running, your back office operation. So whether or not you've got the right processes in place, the right tech solutions, etc. So it's a driver of margin, not just of cash. And I think that's where you can look at working capital management as something that actually adds value to the business rather than simply a process that needs to be done.
Mm-hmm. And in terms of metrics, are you tracking working capital, and what metrics do you have in place?
Well, I think, like everyone, we probably look at the standard DPO, DSO, but I think where we want to take things is bringing in some much more operational based KPIs. So, that would be, for instance, looking at your reconciliation rates, how much of your receivables are automatically reconciled and allocated to outstanding invoices. How many credit notes do you issue, for instance? So, how accurate is your billing? And then on the accounts payable side, do you have terms in place for all your suppliers? Do you pay to terms? So these kind of operational KPIs, not a long list of them, let's pick out a handful. These are things that measure efficiency in the process. And I think, do you have a baseline? Well, perhaps not, but do you want to see continual improvement on those? And so that the process is getting better. Yes, you do. So I think that's one element. And I think also, in a group such as Compass, which is quite decentralized, you have a wide range of, best practice at one end and perhaps, not quite so good practice in other parts of the group. So, it's a mission to find the best practice and make sure it's spread throughout the group.
Yeah, exactly. Great. Thank you. So one final question for you, and it's around supply chain finance. You have a supply chain finance program at Compass. That's right, isn't it?
We do indeed. I mean, it's I think our US program is one of the largest corporate programs in existence. It's a long established. We do have smaller supply chain finance programs in some parts of the rest of the group, but I think it's the US one that's, the main one within Compass. And I think my message there would be, it's successful because it is a procurement-led program, and it's very much around, creating that win-win for the supply chain, but also for Compass. So it's used to support suppliers. There's a benefit to Compass at the end of the day, obviously, but it is a procurement-led process, which is there really to support suppliers. It's part of the overall relationship with suppliers. So it's not just about pricing and terms, but it's also being there, when you need them or they need you. So I think supply chain finance is certainly, when used in this manner, it is beneficial for everyone.
Brilliant. I'm going to jump in there now just to keep the clock moving, but thank you, Ben. Thank you, Jenny, for that. Lots of really good practical advice. Just a friendly reminder to everyone, the questions and answers. I can see a number of people putting questions in there, so please do keep putting questions in. We'll pick those up at the end. But Ben nicely gave us a practical segue over into Maurice and Demica and supply chain finance. And Maurice, over to you really to help us understand how we get the best out of it and how we make it work. So over to you.
Yeah, thanks a lot. Just to jump onto the first slide here, we've got a schematic which shows that supply chain finance really is a family of products, ranging from factoring, forfeiting, receivables discounting, and approved payables finance. And it's approved payables finance I'm going to talk about today. It's also known as reverse factoring, and sometimes it's referred to directly as supply chain finance. But approved payables finance is a product with around 400 billion of volume running through it globally. These are according to McKinsey statistics, and I think these are 2019 numbers, with around $150 billion of assets outstanding. And it is the fastest growing of all of these supply chain finance products. It was growing at around 15 to 20% pre-crisis, and all indications I get from talking to banks is that it has outpaced the other members of the supply chain finance family in terms of growth through the downturn, which is interesting. It's dominated by banks, and platforms like Demica are growing in intermediating the products between kind of corporates and banks. So if we can move to the next slide. So this just gives you a schematic as to how it works. The structure is pretty straightforward in that suppliers are able to take their invoices once they've been confirmed. In the case where Demica is involved, it's run through the platform. So those invoices are uploaded. The data is actually taken from the buyer. The invoices are uploaded, and the supplier then has the option through an online portal to click to sell those invoices either on an automated or selective basis. And then at the end of term, the fund will be repaid by the buyer. What that ends up with is the funder taking concentrated risk on the buyer. And as a result, as I said earlier, it tends to be a product that best sits with banks that have got long-standing relationships with their corporates. And it sits typically with larger, well-rated companies. And that's changing. This used to be a product that really was restricted to the very largest of customers, and it's now shifting. And I think it's the rating of the company that's relevant as it starts to migrate to smaller, to the upper mid market and the mid market. As I stated, it's mainly a bank market. There's growing interest from non-bank investors, both at the investment grade end and below, but it's predominantly a bank market today. So next slide. I think what makes this a good product is that if it's structured correctly, then it creates a win-win for all of the parties that are involved. It's a tripartite relationship between the buyer, funder, and supplier. And what it does for the buyer, and Ben alluded to this, is it'll strengthen the relationship that it has with its suppliers. So if terms have been extended, this gives them a way to access lower cost capital, because the pricing of the facility or the discount rate that's offered to the supplier is based on the credit risk of the buyer. And so there's an arbitrage there that gives the supplier access to cash flow. The buyer is able to support its customers, and the funder ends up with a facility or an asset that tends to stick. So whilst these are short-term receivables that continue to turn, the programs stay in place for a very long time. They become part of the supply chain infrastructure, if you will, if they're used properly. It was interesting listening to some of Jenny's points where she talked about getting the incentives right, strategic priority. That's what we see, where these programs go well, the cross-functional relationship, particularly between procurement and treasury, is aligned up front, goals are set, and the incentives are there to match. And then once you've got that in place, it's all about the supplier onboarding and making sure that you have a supplier onboarding process that optimizes the outcome. It takes time. This isn't a short-term one and done thing, but if done well, as I said, it lasts a long time. So next slide. I thought I'd show kind of where it works, and then there's a slide on where it doesn't. So this is a real life example of a large company that came to us with over 1,500 suppliers and scopes. When we did the analysis, you could see that it's the relatively small percentage of the overall supplier base that's in scope that counts for the most of the spend. And this company, as you can see on the payment terms, had long existing payment terms. They wanted to ameliorate the impact of that on suppliers, so there was no associated request for any changes, or no prior request for any changes, and it was significantly cheaper funding for suppliers. There was a large number of funders interested in the program, and 2 were selected. And so again, it fit the criteria of that win-win. The next one here was a case that came to us with a low-rated company that had in their mind that this was the secret to being able to support a terms extension request, but the suppliers were better rated than the company, and the funder was not underwriting the credit. They were looking for credit insurance for protection, and it just didn't work, right? And it didn't get implemented for those reasons. So obviously these are 2 extreme ends of the spectrum, but we work closely with our clients to put in place facilities that last a long time, and the facilities that run on our platform typically do last a long time. The tenure of an average facility is kind of 8-9 years. Next page. Yeah, I'll just end with a snapshot of the platform. So the Demica platform supports around $18 billion of facilities. The turnover on those facilities is a multiple of that. And what we try and do, and again, I'll kind of draw on some of the words that Jenny used, we try and drive automation of the processes that are involved in onboarding suppliers and create transparency and good data for all of the counterparties. So you can see some of the features there. And that's part of the way in which technology is driving the adoption of these programs as new funders and corporates come to look to take advantage of them.
Brilliant. Thank you very much. A lot of information covered there. So we're just going to spend a bit of time now dealing with some questions and answers. And a few questions have come through various sources. A few have popped up down there. I've got a few that have been sent over to me direct. So if the panel want to come onto camera, and I'll fire the questions in. Jenny, I'm going to go to you first of all, actually. So you talked about this in your section, and a lot of the people looking down the list of who's attended this call, different sectors represented. Are there winners and losers here? What's the survey actually kind of shown in terms of the sectors and the impact it's had on different sectors?
Yeah, so of course there will be winners and losers. In terms of the sectors that are not performing well, they're the sectors that you'd expect. So non-essential retail, you've got tourism, hospitality, leisure. I'd say construction as well. So construction typically working on low margins, historically poor payment performance within the sector. The introduction then of domestic reverse charge, IR35, all of those will provide challenges for the construction sector, absolutely. Thinking of the winners, you have tech companies, obviously. There'll be subsectors within healthcare that are doing very well, even subsectors within manufacturing, if we think about food and beverage. For the growing companies, I'd say make sure you're looking at your net working capital as percentage of revenue to make sure you're not gaining excess working capital. But yeah, there's a lot more insight in the study which we can share after the session.
Brilliant. And I know I've downloaded the report as well, had a little nosy through. There's a lot of information in there about the sectors and things like the amount of free cash by industry and areas like that. I know I've used it to some of my clients to say, hang on, how are you doing compared to best in class? But it's definitely worth getting that report because of the level of detail that is in there and the help to show you best practice effectively in terms of what's going on. Okay, Ben, over to you now, really, a question. And again, Jenny alluded to it at the end of her section around the kind of CSR type responsibility. And a lot of the conversation here with everyone has been about the relationship with the suppliers and not just seeing suppliers as someone to kind of stretch and squeeze and use to kind of fund yourself. Just interested, practical experience yourself from Compass Group's point of view, how you go about kind of managing that supplier side of things and how you get the balance right between looking after suppliers and also the commercial factors for yourselves.
Sure. I mean, let's not pull any punches here. Our procurement teams are out there to try and get the best result for Compass. Pricing is always a very keen focus. But I mean, there's a real culture and understanding within the group that you rely on your supply chain absolutely. And I think I talked about the US program being very successful, and that genuinely is the case. I mean, it's not been used to push out terms beyond sort of normal industry standards out there, but it does genuinely support the supply chain. So I think it's just really important to keep that culture, which we do within the group.
And I think that's been a lovely aspect of this side. I've seen lots of countless examples of big corporates almost flooding their supply chain to support it through to making sure suppliers looked after. So some good aspects coming out from all of this. Maurice, elephant in the room. Greensill. Okay, and just interested in your take on this, or being slightly careful where we go, but just interested in your take on this in terms of the impact it's had on confidence in the supply chain finance sector.
Clearly, the press around Greensill has been negative for the industry. When I talk to treasurers and treasury teams, there's increased kind of vigilance and hesitancy as a result of the very high profile collapse of Greensill. I think if you look at the underlying reasons for Greensill's collapse, it doesn't have very much to do with approved payables finance, as I kind of alluded to it. They had a concentration of programs with very low rated customers, and often those programs weren't approved payables programs at all. Heavily dependent on credit insurance, which dried up. So I think you've got to, we can't run away from the fact that the press is negative. But then, is there going to be an impact of Greensill's collapse on the industry? And I think the preliminary conclusions that we've come to is that it will drive increased transparency. Some of these programs that are put in place are not disclosed. and that varies from jurisdiction to jurisdiction. Well, they should be disclosed. However, the benefits that they offer kind of buyers, suppliers are overwhelmingly not, they're not features of what drove Greensill to have problems. So we think that it was a case of poor decisions rather than a signal that there are systemic problems with facilities across the industry. And whilst there'll be more, increased transparency, it won't lead to that growth rate materially slowing down. And in terms of new business coming through us, it hasn't been affected by Greensill. There's been some hesitancy, and people are looking deeper into the underlying rationales for the programs, but the flow of business continues. And indeed, a lot of Greensill's larger accounts have been picked up by other funders in the wake of its collapse.
Yeah, thank you. That's interesting. And I mean, again, in your presentation, I was quite interested about how much emphasis there was around the relationships between the different parties. And I suppose it'd be useful just your view on the pitfalls, really, of getting this wrong, of misusing the product, and what that kind of could mean for the businesses.
Yeah, I mean, you need this to be a reliable, steady source of cash for your suppliers. So if there's risk that the funder coming in to fund the program has got a short-term view and isn't in it for the long run, or there isn't, kind of backup liquidity to be able to put the suppliers, back onto terms that they can manage commercially, don't do it. And I think it's kind of almost as simple as that. If you've got kind of access to liquidity, as many large companies do, that is so different to what's available through the supply chain, then that creates the arbitrage that makes the product work. And there's no shortage of capital for investment grade and near investment grade companies at very, very compelling rates. So I think it's, that the main pitfall for me is, if you've got a leveraged balance sheet, be very careful about how you use the product. And if you don't, then, make sure that you put in place a program that's sustainable. And you, to Ben's point, don't try and go outside industry terms, to use the program to support very, very long payment terms. Use it in the way it's designed to be used.
Brilliant, thank you. And Mark, finally, I'll come to you and okay, life's pretty good, isn't it? We're unlocking. You can head down the pub and sit outside and buy yourself a pint. You can go to shops. Everyone's feeling pretty good now as the vaccines are being rolled out. I mean, even you were talking about bubble wrapping everything around there and all that. That feels kind of like very, things being protected and all of that. And you referred, I think I'm going to copyright this if it hasn't been done so already, the big splurge. So, is life good? Have we got there? Is this going on? I mean, and I saw questions coming in around this as well about, hang on a sec, you seem to be telling us a different story here. What's going to happen?
The answer is I just don't know. I mean, I can absolutely see. I've just been exchanging some IMs on the chat online with one of the audience, and I think the key thing is we can't say what the path will be. To determine that, I think would be, we can't do that. I think what we can do is horizon scan for what the range of outcomes might be. Everything from, as I put it a while ago, the mother of all booms this year, to a cliff edge with a big scrap over profits as they start to be earned again by that balloon balance sheet group of creditors. And I think the key thing here is just to be alive to where that inflection point's coming, and make sure that you have scenario planned for all the different outcomes, and you think you have a way of trying to work through all of them. So, don't assume, for example, that you can get to the end of June and your landlords will be fine. They might not be. Your landlords might be sitting there sharpening their knife up because they want the site back, or they want to try and throw a spanner in the works in order to get first to that pot. They don't want to get a compromise. They want to try and find a way of leveraging their position. So I think for me, the key thing is use the time we've got wisely, and make sure that you've assessed that range of outcomes and can work through any of that range of outcomes.
Yeah, I think that's interesting. It's that whole scenario point, isn't it? We actually don't know what's happening. I mean, even now, yes, things are looking good for us in the UK, but they're certainly not in other bits of the world, and disrupted supply chains and we don't actually know how consumer trends will have changed through all of this. There's a lot of uncertainty. And as you say, and actually, Ben, you alluded to it as well, that looking for best-in-class process across the whole of the organisation so that actually you can embed that elsewhere. And Jenny, again, you talked about that again, about looking and just simple practical things that can be done. So I think just to wrap up where we're at time, I think encouraging you, please, so just go to the last slide, please do download the working capital report. There's a load of really good information in there. If anything you've heard here is of interest, please contact any one of us and we'll get you through to the right people. But I do know, Jenny, from your point of view, that whole review of the working capital is something you do a lot of with businesses, to say what is best in class, what could be done to optimize it, make sure things are running efficiently in the organisation, and do the best to support. So please do download that report. It's just full of really helpful information and a really fascinating read, actually. And I genuinely mean that. When I download it, I thought, oh, this is really good. So please do have a look at that and download it. Easiest thing, just Google search your BDO's annual working capital study and it should come up. It's hosted in an area with lots of other stuff around Rethink, which is us looking at how businesses are re-exploring and looking at the changes post-COVID and all the changes that means to all different parts of the organisation. So there's a wealth of other information there as well, so do have a look there. But thank you very much, everyone, for joining. A lot of you have joined, so as I said at the beginning, it's clearly a topic that many of you have at the forefront of your mind. Really hope that today was helpful. Big thank you to all of the panellists as well for everything they've done. And thank you very much. Have a great day and keep safe.
Thank you.